While the market chases price action on major caps, Polygon just processed over 5 million transactions in a single day, hit over 8 million active wallets, and secured a partnership that moves $250 billion monthly through traditional finance. Yet the price sits around 16 cents, back at the same accumulation zone where I told you I was loading earlier this year. Those who followed that analysis already banked 87% gains at 30 cents. Now we're back. Is this a second chance, or is something broken? Let's dig into what actually matters. Polygon is trading around 16 cents after retesting support that held in April and early November. This is the third time in 2025 that price has touched this level. The market treats this zone differently now compared to 11 months ago. Back then, everyone was bearish on Layer 2s and scaling Ethereum solutions. Today, we're seeing the opposite sentiment, yet price action remains stuck in the same range. I know Polygon is not a Layer 2, is a sidechain, but people treat it as if it is, since it solves the same scaling problem for Ethereum. Functionally, it competes in the same market. So, the disconnect is fascinating. Fundamentals are accelerating while price remains depressed. Transaction volumes are up 23%, active wallets increased 34% in just 30 days, and stablecoin supply on Polygon grew by $786 million in the past month alone. But technical structure tells us we're still inside a descending channel that started at 77 cents back in December 2024. There's a story here that goes beyond simple price movement, and the Onchain data reveals why this level matters more than most realize. 3 major developments converged this past week that fundamentally change Polygon's positioning. First, Calastone announced they're running tokenized fund share classes directly on Polygon mainnet. This isn't some startup testing blockchain. Calastone is the backbone of global mutual fund infrastructure, connecting over 4,500 financial institutions across 58 countries and moving more than $250 billion every single month. They're not doing a pilot or a demo. They're issuing real fund tokens with actual asset managers participating. Second development. Polygon now dominates over 50% of all stablecoin transactions in Latin America. When you combine this with the fact that they added 786 million in stablecoin supply just last month, bringing the total to 3.2 billion, you start seeing why institutions pick Polygon for payment infrastructure. It's not about speculation anymore. It's about settlements, remittances, and real financial flows happening on-chain. Third piece. Active wallet growth is outpacing every major chain. Polygon hit over 8 million monthly active wallets, the highest level in years. That 31% growth in active addresses over 30 days puts it ahead of Ethereum, Bitcoin, and most Layer 1s. The data shows Polygon is becoming the preferred execution layer for payments, not just a scaling solution for Ethereum. Total value locked sits at $4 billion, with $1.6 billion in real-world assets, which increased 40% in a single month. This fundamental backdrop matters because it creates sustainable demand. Transactions require POL for gas. More users means more fee burn. More institutions onboarding means more liquidity staying on-chain. The question becomes whether technicals will catch up to fundamentals, or if we need more time in accumulation. Looking at the 3-day chart, POL is trading inside a descending channel that formed from that 77-cent high in December 2024. This channel is divided into 2 zones, an upper channel and a lower channel. Right now, we're working the upper channel, but 13 cents is the line in the sand. If price breaks below that level on a weekly close, we drop into the lower channel with support around 6 cents. Current price sits around 16 cents, slightly above our nearest support at 15 cents. That level has held multiple times throughout 2025. Notice those white circles and arrows I marked on the chart, showing how price reacted when Heikinashi RSI hit extreme oversold in the past 2 years. Every single time RSI reached these levels, we got significant bounces. We're entering that zone again right now, with RSI pointing down but approaching oversold territory. The moving averages tell a bearish story. Price is below the 10 and 21 exponential moving averages, those blue lines on the chart. We're also under the 55 EMA in purple and the 100 EMA in yellow. This confirms the downtrend remains intact from a momentum perspective. For any meaningful reversal, we need to reclaim at least the 21 EMA, which sits around 19 cents. Resistance is clear. That descending trend line above us around 20 cents, marked by the orange dashed line. Volume profile shows point of control at 24 cents, which acts like a magnet pulling price higher once we break the immediate resistance. From a Fibonacci perspective, I anchored from 77 cents down to these 15-cent lows. The 236 retracement sits at 30 cents, which represents breaking out of this 15 to 30 cent accumulation range. My strategy remains consistent with what I shared in those 10 previous videos about Polygon. Load zone is 14 to 20 cents. This entire range represents value for long-term holders who understand that fundamentals eventually drive price. For the short-term traders, the stop loss sits at 13 cents on a weekly close. If that breaks, the setup invalidates temporarily. However, I would personally start dollar-cost averaging at 11 cents if we drop to the lower channel. Take profit targets are 30 cents, 38, 50, 75 cents, and ultimately $1.15. I'm trimming more heavily at the first three targets because that's where most resistance clusters. Trailing stops become critical above 30 cents to protect gains. The probability-based view looks like this. If RSI reverses from oversold while fundamentals continue accelerating, we likely test 20 cents resistance within weeks. Break above that trend line with volume, and 24 cents becomes the next magnet through volume profile point of control. Best case scenario involves reclaiming the 21 EMA around 19 cents, then pushing through 24 cents toward that 30-cent Fibonacci level by the end of 2025 or early 2026. Worst case, weekly close below 13 cents drops us into the lower channel, potentially testing 6 to 11 cents before finding support. That invalidates the short-term bullish thesis, but doesn't change the long-term accumulation strategy if you believe in the fundamental adoption narrative. Timeline considerations matter here. Short-term traders need that weekly close above 13 cents to stay in the trade. Long-term holders treating this as an accumulation zone can afford to be patient through volatility. What would change my thesis? A fundamental breakdown in on-chain metrics, specifically if active wallets start declining or stablecoin supply begins leaving the network. As long as real usage continues growing, these prices represent opportunity. Polygon sits at a fascinating intersection. Institutional adoption accelerating while price remains compressed in a year-long accumulation range. The 16-cent level has proven itself as support multiple times. RSI approaches oversold. Fundamentals show sustainable growth. I cannot tell you what POL will do tomorrow or next week. What I can share is that every previous time we hit this zone with similar oversold conditions, significant bounces followed. The data supports accumulation for those with patience and proper risk management. If this breakdown added value to your analysis, drop a like so others researching Polygon can find it. Join my free Telegram group for faster daily crypto updates. Link is in the pinned comment. I recently covered Uniswap's fee switch potential. Check this and my last Polygon video on screen. Stay strategic, not emotional. Thanks for watching, never financial advice, and I'll see you tomorrow in the next one.